Hello again. This is part 2 of the video dealing with chapters 1 and 2, Introduction to Management Accounting. Before, in part 1, we looked at the role of management accountants within organizations. We looked at cost classifications. We paid special attention to the concept of product costs versus period costs. And we saw that product costs include direct materials, direct labor, and manufacturing overhead. These costs are not expensed when they're incurred, but rather they are, first of all, recorded to an inventory asset. And subsequently, when the inventory is sold, these costs are expensed in the form of cost of goods sold. Period costs are marketing and selling related or general administrative in nature. These costs are expensed when incurred. Continuing with our discussion, here's a look at another cost classification, variable costs versus fixed costs. So you would notice here there are three kinds of costs that are listed on the slide. There's variable costs, a cost that will vary in total proportionately with changes in activity levels. So as the activity level increases, the total cost will increase as well. And as the total cost decreases, as the activity level decreases, the total cost decreases. Some examples of variable costs would include the cost of direct materials, shipping costs. The more you ship, the more shipping costs you got to incur, and so on. A fixed cost, in contrast, is a cost that remains constant in total, regardless of changes in the levels of activity. And a handy example of that would be the monthly rent, the insurance, property taxes. These costs don't change as production volumes change. There is a cost category called a mixed cost as well. So a mixed cost is an interesting one because it's got a fixed cost component and it has a variable component. So it's got elements of both variable costs and fixed costs. So an example of that could be that a salesperson, their salary has a fixed portion, a basic salary, and a variable portion which consists of commissions based on sales achieved. So that could be an example of a mixed cost. Sometimes utilities costs tend to be mixed in nature. We will learn more about mixed costs and how to separate them into the fixed cost portion and the variable portion later in chapter 3. Now, with regards to cost behavior assumptions, these assumptions are about how costs behave um, in response to changes in an activity level or production volume. So these assumptions that we make that a variable cost will remain constant per unit, but changes in response to changes in production levels, or fixed costs remain constant in total dollar terms. Um, these assumptions are valid only within a range of activity levels, and that range is called the relevant range because you recall, if you took microeconomics, you'd remember all costs tend to be variable in the long run. There is no such thing as a fixed cost in the long run. So in the short term, within the relevant range, you can have costs that are variable and costs that are fixed. And so the following table summarizes cost behavior. So what do we have here? So within the relevant range, a variable cost in total, so total dollars, will go up or down in response to changes in the production level. But on a per unit basis, the variable costs remain constant. So if my direct material cost per unit is $5, for one unit it's $5. If I produce 500 units, it'll be $5 multiplied by 500, or $2,500 in total. If I produce 1,000 units, it'd be $5 a unit times 1,000. $5,000. So you notice total dollars go up if as the production volume goes up, but the per unit cost remains constant. In contrast, a fixed cost remains unchanged by changes in the activity level within a relevant range. So the total dollars don't change. But if we were to calculate a fixed cost on a per unit basis, so for example, if my factory rent is $10,000, if I was to produce 1,000 units, $10,000 divided by 1,000 units, I get factory rent per unit, $10. Now, the moment my production volume, let's say, doubles, if I was able to produce 2,000 units, my factory rent doesn't change, it remains $10,000, but per unit, that cost will fall. $10,000 divided by 2,000 units gives you $5 per unit. So that's how fixed costs behave. As production volume increases, the per unit fixed costs fall. And as production volume decreases, the per unit fixed costs actually go up. So there is an inverse relationship at a per unit level for fixed costs and production volume. A look at direct versus indirect costs. Now, costs may have to be assigned for many reasons, such as we're trying to understand the profitability of a particular product, or we're trying to get a handle on how we should price a particular product, or we're trying to get control spending on a particular product or activity. So in order to do that, we have to first of all define a cost object. So a cost object is basically something for which data pertaining to costs are needed. It could be a product, it could be customers, it could be the job. So we'd be looking at job order costing in chapter 5 later on. Depending on what it is that we are analyzing, a cost and the level of analysis as well, a cost could be an indirect cost or a direct cost. So what's a direct cost? Again, a cost that can be traced to a single unit of a cost object. If it cannot, then it's an indirect cost. So for example, a factory manager's salary will be seen as indirect if we were looking at the level of a particular batch of product that's manufactured. However, the same factory manager's salary would be treated as a direct cost if the cost object happens to be the entire manufacturing division or that particular factory. Continuing with our discussion of direct versus indirect costs. Formal definition of a direct cost: it's a cost that can be easily traced to a particular cost object. So ready examples would include the cost of direct materials, direct labor, easy enough to remember, I hope, because they contain the word direct in the name itself. An indirect cost is a cost that cannot be easily traced to a particular cost object or a job object. And the example here would be manufacturing overhead that needs to be allocated to a particular job or a cost object. Now, there is something called a common cost as well. So a common cost is a cost that's incurred to support a number of cost objects, not just one cost object, but it can't be traced individually back to those cost objects. So a factory manager's salary, assuming a company produces more than one type of product or produces more than one job, the factory manager's salary is common to all of those jobs produced. So this one ends up being allocated on some basis. Okay. Next up, we have differential costs versus opportunity costs versus sunk cost. Now, first up, a differential cost would be a cost that actually will undergo a difference between the two alternatives, two or more alternatives that you're looking at. Now, the differential could relate to costs, and we'd call it a differential cost, or it could relate to revenues, and we'd call that differential revenues. Another term that's quite linked to the concept of differentials is incremental. So when we're looking at incremental, we're essentially looking at the difference between um, the two costs for any given alternative. So incremental costs would be the amount by which the cost for an alternative is higher than the cheaper cost alternative. Okay, so sometimes when we are looking at decision making, and we'd be devoting some time to this in chapter 12, we would be looking at costs in terms of incrementals. An opportunity cost, well, this term is borrowed from the world of economics. It relates to the potential benefit that we are giving up by choosing one alternative over another, right? So because I chose alternative A, the benefits that alternative B could offer above alternative A is what I'm giving up. That would be an opportunity cost, the cost of an opportunity given up in favor of a chosen alternative. Right? Sunk costs, it's basically a cost that's already been incurred. It can't be changed by whatever decision that we make now or in the future. Now, as a concept, it's pretty elegant, it's pretty simple. However, it's one of the costs that's very difficult for people to forget about or give up on. And very often you find nasty, horrible decisions being made because individuals are just unwilling to get over the fact that there's nothing much they can do about a poor decision that was made in the past. Okay, we will be revisiting these topics later on in the decision-making topic in chapter 12. For now, here's an example, exercise 2-7. We're looking at a consulting firm called Performance Edge that helps develop employee recognition programs for companies, maintains a large inventory of prizes that companies can give to deserving employees. Due to growth and demand for services, Performance Edge is considering selling its existing warehouse and leasing a new, larger warehouse facility. The existing warehouse has a large parking lot that was newly paved last year, and the company rents about 30% of the parking lots to occupants of properties nearby. The new warehouse is expected to be much more energy efficient, and it's larger than what the company needs currently to store inventory. As a result, if they make the move, management plans on subletting about 15% of the space for the next 3 years. The new warehouse is also expected to be cost less with regards to maintenance, but because of the additional size, 2 new warehouse employees will be hired. So the requirement here is to indicate there'll be a bunch of costs that we'll be looking at to indicate whether that particular cost should be thought of as a differential cost, an opportunity cost, or a sunk cost in the decision to move into the new warehouse. Remember, so we have an existing warehouse that we own. We are thinking about selling the existing warehouse and moving over to a new, larger warehouse facility that we're actually thinking about leasing, not buying. So here's a look at the choices. So the first example is done for us. The cost of electricity for the warehouses. If we were to compare the electricity costs for the existing warehouse and the electricity costs for the new warehouse, if the costs are different, the difference will be seen as a differential cost. You notice there's an X that is marked under differential costs. The options that we have are differential revenue, or a differential cost, or an opportunity cost, or a sunk cost. And we are given 8 different cost items that we have to slot either under differential revenue, differential cost, opportunity cost, and sunk cost. So the first one is the revenue from subletting the 15% of the new warehouse that the company intends to do. So this is linked inextricably to the decision to move into the new warehouse. If we move into the new warehouse, we can sublet a portion. If we choose not to, then it's not going to come up. So it is a differential concept, and this will result in revenue for the company. So this will be an example of differential revenue. Look at the second one, lease payments for the new warehouse. Now again, this is linked to the decision of moving into the new warehouse. If we choose not to move into the new warehouse, we don't have to worry about it. But if we do choose to move into the new warehouse, then we'll have to make the lease payments. So this would be reflective of a differential cost of making the move. Number 3 is net book value of the existing warehouse. You remember from accounting 2121, net book value is basically cost minus accumulated depreciation. So the cost less accumulated depreciation of the existing warehouse will remain the same regardless of whether we choose to move into the new warehouse or not. So essentially it represents a sunk cost. A sunk cost is a cost that doesn't change or doesn't differ. It's a cost that's been incurred in the past. So the cost of buying the old warehouse, and since its purchase date, the depreciation that's been accumulated on it, it's all there on the books, but it's something that is unaffected by our choice of moving over to the new warehouse. Whether we choose to move to the new warehouse or not, this particular cost ain't gonna change, right? It's not a differential cost, it's a sunk cost. Now, number 4 is sales proceeds from selling the existing warehouse. So if we choose to sell if we choose to move into the new warehouse, first of all, then we won't need the existing warehouse. So we can then sell it. So this will result in actually cash flow coming in. So I hate to put it under differential revenue. For some reason, your textbook authors have put this under differential revenue. For decisions like this, it's actually cash flows that we look at more carefully. So the intention is cash flow. If you take courses later on in accounting, let's say the intermediate management accounting course, you will learn about capital budgeting. You learn about the concept of net present value. And net present value is calculated using cash flows. So we would consider the fact that if we don't need the existing warehouse, we can sell it and that'll result in cash flows coming in. So I guess that's where the intent was for the textbook authors. They've put it under differential revenue, take it with a pinch of salt. It isn't really revenue, it is actually cash flow coming in. It's just selling off an asset. Sale of an asset does not result in revenue. Uh, it results in, a way to think of it is it'll result in lowering your initial cost of the new warehouse, right? So if the new warehouse, whatever the new warehouse costs us, what the amount of cash that you're able to recoup by selling the existing warehouse, it will reduce the amount of initial outlay for the new warehouse. So regardless, we're currently putting it under differential revenue with a caveat. Number 5, for the warehouse maintenance costs. So these maintenance costs, if there is a difference between the maintenance costs for the new warehouse and the maintenance costs of the existing warehouse, these will be put under the category of differential costs. Likewise, if the warehouse staff wages, if we look at the warehouse staff wages, fact that the new warehouse will require us to hire 2 new persons will mean that there will be a difference between the warehouse wage costs for the new warehouse and the existing warehouse. Okay, so the difference will be put under differential costs. Paving costs for the parking lot of the existing warehouse. Now, guess what? Those paving costs have been paid for in the past, and whether we choose to move to the new warehouse or stay put in the existing one, that cost, the fact that we incurred paving costs on the existing warehouse is not going to change. And so that represents a sunk cost. The last of the lot, parking lot revenues for the existing warehouse. Now, if we choose to move over to the new warehouse, we don't have an abundance of parking space to sublet. So whatever revenues that we earn from renting out parking space in the existing warehouse, listen, if we choose to move to the new warehouse, we will sell the existing warehouse. If we are going to sell the existing warehouse, we will not be able to rent out parking space on the existing warehouse. If you're not able to rent out parking space, the revenues will disappear. So it will be the benefit that we'll be foregoing or giving up on should we choose to move to the new warehouse. So that represents an opportunity. Okay. Next up, we'll move on to the concept of cost of goods manufactured. Now, cost of goods manufactured is calculated thus. We start with the cost of direct materials that were used for production. Add to that amount the cost of direct labor and the cost of manufacturing overhead incurred during the period of time. The cost of goods manufactured is always calculated for a period of time. Could be for a month, could be a quarter, could be a year, depending on the size and sophistication of the company. These 3 amounts, direct materials, direct labor, and manufacturing overhead, added together represent total manufacturing costs. Now, total manufacturing costs is not the same thing as cost of goods manufactured. There's a couple of adjustments that you have to make. So to this total manufacturing cost amount, you want to add the cost of beginning work in process. Now, whatever work in process dollar amount you had at the beginning of the period, during the current period, you would have completed production of that work in process items. So part of the total manufacturing costs incurred in the current period relate to the cost of completing manufacture of the beginning work in process. Similarly, part of the total manufacturing costs incurred in the current period relate to the costs of the goods that still remained in work in process at the end of the period. Now, because these goods are not completed, we need to subtract the cost of ending work in process from the total manufacturing. Add beginning work in process, subtract the ending work in process, and what you're left with is the cost of goods manufactured. So this is essentially the cost of complete goods, finished goods manufactured in the period of time. Okay? Next up, we're going to take a look at the schedule of cost of goods manufactured. So when calculating cost of goods manufactured, you want to first calculate the raw materials, the direct materials that were used in production. So in here, what we do is you look at the flow of raw materials. So unless the company started operations brand new for the first time, it would have started the year with some inventory of raw materials at the start. So beginning raw materials inventory. You will add to that the raw materials, the cost of raw materials that were purchased during the period. Added together, we get a total dollar amount of raw materials that were available for the company to use for its production. Any ending raw materials inventory indicates that out of the total raw materials that were available for use, not all were actually used. You want to subtract the ending raw materials inventory from the raw materials available for use to get raw materials used in production. Next up, you'll have direct labor, and that should be a fairly straightforward process. It's about keeping track of the wages paid to employees that actually manufactured the goods. And then you'd look at manufacturing overhead. And manufacturing overhead, remember, is all manufacturing costs that are not direct materials or direct labor. So you'd include indirect materials, indirect labor, and any other factory-related costs. Direct materials, direct labor, and manufacturing overhead added together give us total manufacturing costs. To this, remember, there's two adjustments to be made. You will add the cost of beginning work in process inventory and subtract the cost of ending work in process inventory. And what you're left with is the cost of goods manufactured. Here's a little numerical example to look at. Problem 2-25. Now you're given 4 cases. It's a summarized schedule of goods manufactured. You're given information on direct materials, direct labor, manufacturing overhead, total manufacturing costs, beginning work in process inventory, ending work in process inventory, and costs of goods manufactured for cases 1, 2, 3, and 4. Now, what I'll advise you to do is pause the video at this point and try to calculate the missing numbers that are indicated by the question mark symbols. Okay, so pretending that you did pause the video and tried to calculate the missing numbers, I will now go through the calculation of the missing amounts. So notice, in the first case, we were given $5,600 of direct material costs, $1,600 of direct labor costs, and $8,000 of manufacturing overhead costs. Those three costs added together give us total manufacturing costs of $15,200. Now, this $15,200, you would have added to this amount the beginning work in process, which is something that we don't know. We have to figure out. But whatever that beginning work in process number was, added to 15,200 and subtracting the ending work in process inventory of $3,200 gave us cost of goods manufactured of 14,400. So a way to think about is whatever was the beginning work in process inventory, that number added to the total manufacturing costs minus $3,200 of ending work in process inventory equaled $14,400 of cost of goods manufactured. We're kind of looking at working backwards here. What if we did work backwards? Well, if the cost of goods manufactured was 14,400 and the ending work in process inventory is $3,200, then these two added together give us 17,600, right? Now, if our total manufacturing costs are $15,200, the beginning work in process inventory essentially must have been the difference between the 17,600 and the 15,200. That difference works out to $2,400. Now see if it works. Total manufacturing cost 15,200 plus the $2,400. See, it'll actually give you 17,600. And from the 17,600, if you take away $3,200 of ending work in process, you are indeed left with cost of goods manufactured, $14,400. Looking at case number 2, they gave us direct materials, 10,400, direct labor, 4,600. They did not provide us with the manufacturing overhead costs, but they tell us that total manufacturing cost is 28,800. Now, whatever the manufacturing overhead cost is, that number added to the $10,400 of direct materials and the $4,600 of direct labor equals 28,800. So basically, it's a matter of figuring out the difference. So direct materials and direct labor, they add up to 15,000. If the total manufacturing costs are 28,800, then it's got to be that manufacturing overhead equals the difference. 28,800 minus the 15,000, $13,800. Okay. The next missing number is the cost of goods manufactured. Total manufacturing costs are 28,800. Beginning work in process was $1,200. So if you add $1,200 to 28,800, you get $30,000. From the $30,000, if you take away the ending work in process inventory, 4,000, you get $26,000 for cost of goods manufactured. All right, looking at case 3, we've been given the cost of direct materials and manufacturing overhead, and we have been given total manufacturing costs. What we've not been provided with is the cost of direct labor. Of course, since we know that direct materials plus direct labor plus some manufacturing overhead must be equal to the total manufacturing cost, we can calculate the cost of direct labor as basically the missing amount when we subtract from total manufacturing costs of $19,800, the cost of direct materials and the cost of manufacturing overhead. So 19,800 minus 6,600 minus the 7,700, you've got $5,500 being the cost of direct labor. In a similar vein, given that total manufacturing costs are 19,800 and the beginning work in process inventory is 2,200, the two numbers added together, 19,800 plus 2,200, gives us $22,000 in total. Because the cost of goods manufactured is provided to be $17,600, we can calculate the ending work in process inventory as the missing number, 22,000 minus 17,600, $4,400. Finally, with case 4, we're given direct materials, direct labor, and manufacturing overhead. We can add them up to get the total manufacturing costs of $30,500. The beginning inventory cost is not provided, but case 4 is very similar to case 1. We can calculate the total of the cost of goods manufactured and the ending work in process inventory. So ending work in process inventory is 1,900. The cost of goods manufactured is $29,900. If we add the two amounts, you get $31,800. So given that the total manufacturing cost is $30,500, the beginning work in process inventory it's got to be the difference, which is $1,300. Next, we'll look at the calculation of cost of goods sold for a manufacturing company. For a manufacturing company, you would start with the beginning finished goods inventory. Finished goods, remember, are goods that are intended for sale to outside customers. Now, because we are a manufacturing company, you would add to the beginning finished goods inventory the cost of goods manufactured, which we just learned how to calculate. Added together, we get cost of goods available for sale. Now, if the company's got any inventory left over at the end of the year, it means that out of the total cost of goods available for sale, some were not sold. And that's basically the cost of the finished goods inventory. So subtract the ending finished goods inventory from the cost of goods available for sale, and you get cost of goods sold. Here's an application example. So before that, we would be looking at the income statement for a manufacturing company. So for a manufacturing company, you will begin with sales revenue. And that's basically the number of units sold multiplied by the unit selling price. Sales minus cost of goods sold. So the next item after sales is cost of goods sold. Now, cost of goods sold for a manufacturing company, we just learned how to calculate that. It's beginning finished goods inventory, add cost of goods manufactured to get goods available for sale, take away the ending finished goods inventory from the goods available for sale to get cost of goods sold. Now, sales minus cost of goods sold equals gross margin or gross profit, as you learned in your introductory accounting course 2121. From gross margin, we're supposed to deduct operating expenses. Now, operating expenses, there could be a whole bunch of them, but typically they can be classified under selling and marketing expenses and administrative expenses. So this one's a really high level look at the income statement. So assuming that you've captured all your selling expenses and the administrative expenses, you add them up, deduct the total from gross margin to get operating income. Now, yes, in accounting 2121, you learned about other revenues and expenses and deducting income taxes to get net income. all that's fine and dandy. Here, we're just trying to get a sense of what the company's pre-tax income is. We're looking at it from the vantage point of running operations. This income statement is for the consumption of the managers that are working inside of the company. This is not intended to be reported to an outside user, the shareholders or the bankers and so on. So it'll not have some of the niceties that you learned about in the other course. Okay, so most of the time we are going to make an income statement that's going to end at operating income. We will not throw at you other things like other revenues and other expenses, gains and losses on sale of equipment, et cetera, et cetera. We will keep things very civil and simple here. The only thing that you may at times be given is the income tax rate. So if you were told the income tax rate for this company was 20%, you can calculate 20% of the operating income. 150,000 times 20% would be $30,000. You'll take away the income tax expense and give net income as your final answer. The net income in this case will be 120,000. So I do hope that you'll be able to adapt to those subtle changes, but they're not going to be radical changes. Here's a continuation of the example from problem 2-25. Again, a bunch of missing numbers. This is the income statement portion. Still the same 4 cases. You're given numbers on sales, the beginning finished goods inventory, the cost of goods manufactured, goods available for sale, ending finished goods inventory, cost of goods sold, gross margin, selling and admin expenses, and operating income. Okay, so this one is an opportunity to refresh our minds about what an income statement looks like. So in case 1, the goods available for sale is the first missing number. You got to remember, goods available for sale is nothing but beginning finished goods inventory plus the cost of goods manufactured. Beginning finished goods inventory is $4,800. Cost of goods manufactured, $14,400. Two added together give us goods available, $19,200. That's the total cost of goods that we could have sold if we were to be sold out. However, considering the fact that we do have ending finished goods inventory worth $7,200 remaining, the cost of goods sold actually must have been the difference, 19,200 minus the 7,200, or $12,000. So if we had sales of 20,000 and our cost of goods sold is 12,000. So another way to put that is we sold goods that cost 12,000 for 20,000. So we sold them at a profit. How much? The difference, $8,000. And that's our gross margin before accounting for operating expenses. Operating expenses, remember, include the selling and marketing expenses and general administrative expenses. In this example, they just combined those expenses into a single number, 4,800. So if we had a gross margin of $8,000 and our selling and admin expenses were $4,800, our operating income was 8,000 minus 4,800, or $3,200. Okay, in case 2, we have a few missing numbers. We're not given the beginning finished goods inventory, nor are we given the cost of goods manufactured. Now, keep in mind, this was a continuation of the earlier cost of goods manufactured calculation that we looked at a couple of slides ago. So the first thing that we should do is copy down the number we had computed in that slide. And so for case 2, the cost of goods manufactured was $26,000. That actually helps us a little bit, okay? It helps us a little bit. Now, considering that the company had a cost of goods sold of 30,500. And the ending finished goods inventory was $4,600. If you're working backwards, whatever was the goods available for sale, of that amount, if you take out $4,600 of ending finished goods inventory, you're left with cost of goods sold of 30,500. Right? So if you work backwards, our goods available for sale must have been 30,500, the cost of goods sold, plus 4,600, the goods available for sale, or $35,100. Now, if 35,100 was the cost of goods that were available for sale, and the company manufactured goods costing 26,000 in the period, the beginning finished goods inventory must have been the difference. So 35,100 minus 26,000, or $9,100. This one was a little bit tricky on that count. The rest of it is not too bad. If you look at the sales, 46,000, and cost of goods sold is 30,500. 46,000 minus the 30,500 gives us gross margin of 15,500. And we're given that operating income for the company was 6,300. So if the gross margin were 15,500 and we were left with $6,300 of operating income, that can only happen if the selling and admin expenses were the difference between the two amounts, or 9,200. Case 3 is somewhat similar to case 1 in the sense that you have to first calculate the goods available for sale, which is beginning inventory 7,700 plus the cost of goods manufactured 17,600, or $25,300. Out of the $25,300 available for sale, if we sold goods costing 19,800, then the difference, 5,500, represents the cost of the ending finished goods inventory. And because the company's sales were 33,000 and the cost of goods sold is 19,800, the difference, 13,200, represents gross margin. Considering that the operating income for the company is 3,300, 13,200 of gross margin minus the operating income, $3,300, gives us $9,900 for the missing selling and administrative expense. Case 4, once again, you'll add up the beginning finished goods inventory to the cost of goods manufactured to get goods available for sale, 38,500. From 38,500, you'll take away the ending finished goods inventory to get cost of goods sold, 31,800. Deduct 31,800 from sales to get gross margin, 15,700. And from the 15,700 gross margin, if you take away selling and admin expenses, you get operating income, $6,200. So that brings us to an end to this lecture video. We will be doing practice problems in class. And I just want to make it clear that if we're not able to cover a question in class, I'll still encourage you to do it on your own and check the solution from the solutions posted on Blackboard. However, I'm going to try to make sure that in class time, we will be able to take as much of problem 2-17, 2-22, and 2-24. If I'm not able to do any of these questions, I may try to post a recording of the solution. Please do take the time of viewing the recording if the recording is posted, and if it's not, if we are not able to get down there, get that done, then you still must try to find some time to go through the solution. All the solutions to the end of chapter problems from the textbook are posted on Blackboard. All right, so that's all, folks. This is the end of the lecture video for chapters 1 and 2. I will be posting similar video for chapter 5, which is the next chapter that we'll be covering. And that's on job order costing. All right, bye-bye. This is Harjinder signing off. Take care.